And to that point, Jared, with the Federal Reserve set to raise rates by 75 basis points for a fourth consecutive meeting, investors are trying to battle the twin headwinds of recession risks and tighter monetary conditions. For more, let's welcome in Fred Hubler, Creative Capital Wealth Management Group President and Chief Wealth Strategist. We're also joined by Geetu Sharma, AlphasFuture founder and investment manager. Geetu, let's start with you. The Fed expected to raise rates by 75 basis points. Then in December, who knows if it's 50 or 25 basis points or if it's a pause there. What are you expecting, and what are you expecting the markets to do?
Hi, I agree with you. There's a lot of uncertainty out there right now, and this week is going to be quite telling. The 75 bips rate hike in November is very much priced in, and we can expect the Fed to give that. But December is looking, the market itself is not sure what December is going to be, but we have seen a bit more dovish expectations in the market. We've seen a very strong rally in equities and bonds. And but I think there is a risk that actually the Fed, even if they want to keep that option of reducing the rate hike pace in December, I think that the Fed is actually not going to be as dovish as the market is expecting. And there are a number of reasons for that. I think firstly, while the economy is slowing, which is what the Fed wants, we are not seeing the pace of slowdown as much as they would like to see. Inflation remains very high, and inflation expectations for the long term, we saw the recent consumer expectations have actually come in higher. And so given how strong the US consumer is, the spending remains strong. And the other important metric that the Fed looks at, which is the unemployment rate, is actually the lowest ever. So as long as we have these conditions, I think the Fed is likely to stay focused on monetary tightening, because the last thing they want is the inflation expectations to get even more entrenched than what they already are.
And Fred, are you expecting the Fed to stay hawkish? And if so, what impacts could we see? Because so many market watchers talk about the 6 to 9 month lag time between what the Fed does and what we see in the economy. We already have seen what has happened in England with the pension funds and what the Bank of England has had to do. Do you see any cracks happening in other parts of the economy, whether it be here in the U.S. or abroad?
Yeah, we see a lot of cracks. And at the end of the day, the Fed's job isn't to make the markets happy. And they have decided and have determined more than once they're going to keep doing what they need to do to break inflation. The analogy we've been using with our clients is there's blood on the streets. It just hasn't gotten to your door yet. So until the consumer slows spending, we're not going to see a lot of inflation tap down. People are still buying things, and once the consumer changes they're starting to change their behavior, then the sales that companies are expecting won't be as much as they thought, and you're seeing it with mixed earnings in the third quarter. So it's a lag from consumer behavior rippling through the economy. The expectations for the market are almost always in their best interest, in the market's best interest. So they want things to happen so bad. They talk about, they kind of telegraph what their intentions are. And I think the Fed's going to do what it needs to do. And I think there's pain that needs to happen that isn't yet reflected in all the numbers we're seeing. And the pain would be, more job losses, companies slowing down growth, and maybe even doing some layoffs. And the cracks are almost everywhere. And there's not many places where between COVID, inflation, and the excess spending, and even what's going on in energy, all of those places are kind of happening at the same time. And what concerns us is more fixed income and equities. It's very frothy, and when we're supposed to have a bad month, we have the best month we've ever had. So the only thing good news is that your Yahoo skit segment about watches makes me want to buy watches so we can, spend some time looking at the markets.
Geetu, just speaking to where investors, should they be looking at watches or not? What do investors do here? How do investors position themselves? Because you say that international markets are really attractive on a pure valuation basis. Are you suggesting going into international markets, and what type of assets, if so?
Well, so I think international markets are attractive on a valuation basis, but we also have a higher risk of recession there. So I think the risk is higher in those markets, and that is what is getting priced in. So no, it's not that I'm absolutely recommending investing in international markets, because I think the U.S. economy is very strong. And U.S. companies are a lot more resilient, a lot more defensive, have higher pricing power, and we have an attractive dollar, which makes international markets less attractive in their local currency. So no, I'm not recommending that, but it is something that we are watching. And if we do see a recovery in the economic environment, we see a resolution to the war, or some kind of supply chain normalization across China and other countries, then potentially we could see attractive opportunities there.
And Fred, just quickly, you're bullish on energy. Energy has done very well this year. You still see a runway there?
So looking at the longer term, energy is the thing that makes modern society work. Now, where we get it from is a whole other conversation. But at the end of the day, energy in more developing countries is not even where it needs to be for everyone to have what they want. So although we might not see, we're kind of being more efficient with energy use in North America, the energy isn't even getting where it needs to be over places. So at the end of the day, I think the use of energy exploded 16 times in the 1900s. The growth of energy is what makes modern life possible. So when you're looking at what can't go wrong, we all need to plug into something. And so, recessions, people still want to have their lights on and their heat. Where it comes from is a longer conversation. But at the end of the day, I think there is always going to be demand for energy. And with what's going on with Ukraine and Russia, it makes it more of an awareness that, energy is national security. And we need to make sure that as a country and countries around the world need to make sure they have the energy. If they have the deposits, they have the way to get that out of the ground for their own self-interest.
Geetu Sharma, AlphasFuture founder and investment manager, and Fred Hubler, Creative Capital Wealth Management Group president. Thank you both for joining us today.